Have you ever wondered why stock prices go up and down every day? One day a stock might be soaring and the next it's dropping like a rock. You see it all the time, headlines flashing red and green, numbers going haywire. But what does it all actually mean? It can seem like a chaotic game with no rhyme or reason, but trust me, there's a method to the madness. It's not just some random number generator, it's about real companies and real forces that drive those prices. Understanding these forces is the first step to becoming a successful investor. So if you're tired of feeling lost in the world of stocks, or you're just starting out and want to learn the right way, you're in the right place. Today, we're breaking it all down in simple, beginner-friendly terms so you can finally understand how stock prices are determined. At its core, the stock market operates on a fundamental principle that governs pretty much everything: supply and demand. Think of it like your favorite pair of limited edition sneakers. If everyone wants them because they're the hottest new thing, the price is going to skyrocket. Sellers know they have something special, and buyers are willing to pay a premium to get their hands on them. The same goes for stocks. If a company is perceived as the next big thing, maybe they have a revolutionary product or their profits are going through the roof, more investors are going to want a piece of that pie. That increased demand is going to push the price of their stock higher and higher. On the flip side, imagine those same sneakers going out of style. Suddenly, nobody wants them anymore. What happens? The price plummets. Sellers are desperate to get rid of them, even if it means accepting a much lower price than they originally paid. That's exactly how it works with stocks. Now let's dive into one of the most significant drivers of stock prices: a company's financial performance, specifically their earnings reports. These reports are like report cards for companies, giving investors a snapshot of how much money they made or lost over a certain period, usually every quarter. Think of it like this. You're a potential investor in a lemonade stand. Would you be more likely to invest if you knew the lemonade stand was making a profit every single day, or if it was constantly in debt? The answer is pretty obvious, right? The same logic applies to companies trading on the stock market. When a company releases its earnings report, investors are looking at a few key things: revenue, which is the total amount of money the company brought in; earnings per share, which tells you how much profit the company made for each share of stock; and guidance, which is essentially the company's outlook for the future. If a company smashes its earnings estimates, meaning it makes more money than analysts predicted, investors get excited. It's a sign that the company is firing on all cylinders, demand for its products or services is strong, and the future is looking bright. This excitement often translates into increased demand for the stock, pushing its price higher. On the other hand, if a company misses its earnings estimates or reports disappointing guidance, it can send shockwaves through the market. Investors might start doubting the company's ability to maintain its profitability or its future growth prospects. This can lead to a sell-off, with investors dumping their shares and sending the price plummeting. But here's the thing about earnings reports. They're not just about the raw numbers, it's also about how those numbers stack up against expectations. Sometimes a company might report decent earnings, but if they fall short of what analysts were expecting, the stock price could still take a hit. In today's hyper-connected world, news travels at lightning speed, and the stock market is often the first to react. Positive news can send stock prices soaring, while negative news can trigger a rapid decline. It's like a roller coaster ride, with sudden twists and turns that can leave investors feeling both exhilarated and terrified. Let's say a pharmaceutical company announces a breakthrough in developing a new drug for a major disease. This is huge news. Investors get excited about the potential for massive profits, and demand for the company's stock goes through the roof, driving its price up. On the flip side, imagine a major oil company faces a massive oil spill disaster. This is devastating news, both for the environment and for the company's reputation and bottom line. Investors worry about the potential for lawsuits, fines, and a tarnished brand image, leading to a mass exodus from the stock, sending its price plummeting. But here's the thing about news-driven market movements. They can be incredibly unpredictable and often short-lived. Remember, the stock market is forward-looking, meaning it's always trying to anticipate what's going to happen next. So, a piece of news that seems groundbreaking today might already be priced into the market. That's why it's crucial to be cautious about reacting emotionally to every news headline. Don't get caught up in the hype or panic sell based on a single news story. Chapter 4. Riding the Economic Wave: Market Trends and Economic Factors. Just like a ship navigating the open seas, the stock market is constantly affected by the currents and tides of the overall economy. Economic booms can lift all boats, propelling stock prices higher, while recessions can drag them down like an anchor. Think about it. When the economy is strong, businesses are thriving, people have jobs and money to spend, and consumer confidence is high. This positive environment translates into higher sales and profits for companies which, as we've learned, is good news for stock prices. During these economic expansions, you'll often see stock prices rise across the board, even for companies in different sectors. It's like a rising tide that lifts all boats, as investors are optimistic about the future and willing to pay a premium for stocks. However, when the economy contracts and enters a recession, things can get a bit choppy. Businesses tighten their belts, lay off workers, and consumer spending plummets. This economic downturn can lead to lower corporate profits, and you guessed it, declining stock prices. During these periods of economic uncertainty, investors tend to become more risk-averse, pulling back from the stock market and seeking refuge in safer assets like bonds or gold. This flight to safety can exacerbate the decline in stock prices. But here's the thing, the stock market is forward-looking, remember? It often starts to anticipate economic recoveries well before they actually happen. So, even when the economy is still struggling, you might see stock prices start to rally as investors anticipate a brighter future. That's why it's crucial to stay informed about economic indicators like GDP growth, unemployment rates, inflation, and interest rates. Chapter 5. Now let's dive into the world of different investor types because understanding their strategies can also shed light on stock market movements. First up, we have the long-term investors, the patient giants of the market who believe in the power of time and compounding. These are the folks who buy stocks with the intention of holding them for years, if not decades. They're not fazed by short-term fluctuations or market noise. They're in it for the long haul. Think of them as the marathon runners of the investment world, pacing themselves for the long run. Long-term investors focus on identifying companies with solid fundamentals, strong management teams, and a competitive edge in their respective industries. They believe that over time these quality companies will weather economic storms, innovate, and grow their earnings, ultimately rewarding their patient shareholders. They're like gardeners carefully cultivating a portfolio of high-quality companies, nurturing their growth and reaping the rewards over time. They understand that Rome wasn't built in a day, and neither is a successful investment portfolio. One of the key advantages of a long-term investment strategy is that it allows you to ride out market volatility. Stock prices will inevitably go up and down in the short term, but over the long term, the overall trend of the market has historically been upward. Chapter 6. In contrast to our long-term investors, we have the swing traders, the nimble surfers of the market who aim to profit from short-term price swings. These traders are less concerned with a company's long-term prospects and more focused on identifying and capitalizing on short-term price movements. Think of them as the day hikers of the investment world, looking for quick wins and exciting trails to explore, rather than committing to a months-long expedition. They're constantly scanning the market for opportunities to buy low and sell high, riding the waves of market sentiment. Swing traders utilize technical analysis, studying charts, patterns, and indicators to identify potential entry and exit points for their trades. They look for trends, momentum shifts, and support and resistance levels to guide their trading decisions. They're like skilled pilots, navigating their planes through air currents, using their knowledge and tools to identify the optimal path for a successful flight. They understand that the market is driven by fear and greed, and they aim to profit from those emotional swings. Swing trading requires a different skill set than long-term investing. It demands a higher risk tolerance as short-term market movements can be unpredictable and volatile. It also requires more time and dedication, as swing traders need to constantly monitor the market and be ready to act quickly when opportunities arise. Chapter 7. Now if swing traders are the day hikers, then day traders are the extreme sports enthusiasts of the stock market. They live for the adrenaline rush of fast-paced trading, executing multiple trades within a single day, and closing out all positions before the market closes. These are the folks who treat the stock market like a video game, constantly seeking out opportunities to rack up points, or in this case, profits. They thrive on volatility, using leverage and short-selling strategies to amplify their gains, but also their potential losses. Imagine them as the fighter jet pilots of the investment world, making split-second decisions, executing complex maneuvers, and pushing their skills and nerves to the limit. They're laser-focused on the present, reacting to every tick of the market with lightning-fast reflexes. Day traders rely heavily on technical analysis, using sophisticated charting software, real-time data feeds and algorithms to identify and exploit fleeting price discrepancies. They're looking for any edge they can get, even if it's just a few cents of profit per share. However, day trading is not for the average investor. It's incredibly risky, and the vast majority of day traders actually lose money. So, there you have it. We've covered the fundamental forces that drive stock prices, from the basic principles of supply and demand to the influence of company performance, news events, and economic trends. We've also explored different investor types and their strategies, each with its own risk and reward profile. As you've learned, the stock market is a complex and dynamic system, influenced by a myriad of factors. There's no magic formula or crystal ball that can predict its every move, but by understanding the underlying forces at play, you can make more informed investment decisions. Now that you understand how stock prices are determined, what do you think is the biggest factor? Earnings reports, market news, economic trends, or maybe it's the constant interplay of all these factors? Let me know in the comments. Subscribe and share for more stock market insights.